So there's going to be a shortage of capital, and we're going to have bank runs. I mean, so far what the Fed's been doing is just when the dominoes are about ready to fall, they arrange the white knight to come in, whether it's JP Morgan or Wells Fargo or whomever, to acquire the bank, and they take the losses. Is that more in the future here, or is there going to be an end to that as well?
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. This is Financial Survival Network. I'm your host, Kerry Lutz. Well, the Greater Depression, you heard about it on the show for over a decade. It got staved off in 08 and 09, but perhaps there's no stopping it now in 2023, 2024, and on. What is that going to mean for you? What is that going to mean for your retirement or your investments? Our good friend Michael Markowski is with us now. Michael, it's great to have you back on. You find him at alphatak, TACK.com. Michael, you've made some pretty amazing predictions over the years. The September 08 crash, the June 2016 Brexit crash, the October to December 2018 market crash. They kind of go on and on, not to mention not just crashes, but the January 22 peak and the 2009 end of this secular bull market. So tell us what your crystal ball is showing you right now.
Well, based on my most recent look at the inflation rate and the S&P 500 and the S&P 500's dividend yield, I'm looking for the market to decline from this level by the end of the year by 38% decline, which should be the bottom, unless something changes. That's what I'm looking for, 38% decline from here. And I expect that will, I can't tell you exactly when that's going to happen. Like in my article that predicting the 2008 debacle, that came out in September of 07, when I predicted all the brokers would collapse, Lehman, Bear Stearns, Merrill Lynch, all of them, and they did. So, So I'm looking for a 38% decline, and I'm looking for that to cause the U.S. to go into, that will be about a 46 or 7% decline from the peak. And you need a 45% decline to be one of the ingredients for an economy to go into a depression of the stock market. So, I'm predicting that we'll see that, happen. We'll enter this thing by the end of the year.
That brings it around. Any way to print their way out of it? Is there anything that they can do to try to mitigate this?
Not with inflation. The Fed did not have an inflation problem in 2008. They didn't have an inflation problem in 2020. Now they've got an inflation problem. So no, it's not. They can't print the money. It's politically. We have an election year coming here, 2024, and it's politically incorrect right now to launch more stimulus. Okay, we've already launched a bunch of 2020. We've run up the national debt significantly, probably doubled it or tripled it since 2008. So there's no cushion, and the problem with it is the politicians are going to argue that it's going to raise inflation. Everybody knows if you bring in stimulus, it's going to maintain or increase inflation.
So they basically got no exit strategy here. There's nothing that they can do. If the U.S. goes into the Greater Depression, as many called it, the rest of the world follows us, correct?
That's right. And so, my articles, my article about the cash flows and video, which are on at alphatech.com, talk about that.
We'll link to it in the show notes.
That came up. That is, the cash flows for the biggest companies, Amazon, Google, Facebook, all of them are slowing. After having, momentum, year after year increases, they're slowing. That's one of my articles that, so I came out and made this prediction that we'd go into a depression a year ago, June of 2022. And so I've had a cash flow is now operating cash flows for the biggest companies are now increasing the probability of that happening by the slowdown of the cash flows. The second thing is the regional bank crisis. The regional bank crisis has caused another big problem because it's put a damper on real estate, commercial real estate, and construction and all of that because of the regional banks the shares are under pressure. They've had one after another having to be rescued. People are moving their money out of regional banks into the big banks. There's only 43 banks that have been stress tested, and those are the biggest banks. And you have 4,700 that haven't been. So if you're a business and you have a couple 100,000 in the account to make your payroll and you're a regional bank, you're going to say, what do I do if this regional bank has to go out? I can't wait for the FDIC to come in. I've got to move my money. So the point is the money's flowing out of the regional banks into the big banks, and that's another big cause for a depression, So
there's going to be a shortage of capital, and we're going to have bank runs. I mean, so far what the Fed's been doing is just when the dominoes are about ready to fall, they arrange the white knight to come in, whether it's JP Morgan or Wells Fargo or whomever, to acquire the bank, and they take the losses. Is that more in the future here, or is there going to be an end to that as well?
Well, actually, JP Morgan just came out today and said that they're not buying any more of these regional banks. They're not putting any more money in them. So that's no longer an option. And, everybody, JP Morgan is the creme de la creme of all the banks. So, if Jamie Dimon's not doing it, there's no political pressure on anybody else to do it either. So I don't see the banks or the big banks rescuing the little banks. And I think it's just going to be a continuous problem. And it's a serious problem.
So we're going to see a bailout. What are they going to do? They can't just let the system go down, even though that appears to be what's happening. Do they just take all the deposits and they put them into FedCoin and just wipe out everybody else? Is that what's going to happen?
Oh, I don't know about FedCoin, but I think they're just the banks are until Congress comes in and increases the FDIC's. If that's another issue, that's another problem. You got to get Congress to come in and increase the amount of money in the FDIC's accounts. So this is a serious problem. The bank issue, I would say, it's the number one problem, the regional banks. And the problem is the bank runs, it's not like, you go back to the 1920s, era 30, 31, 32, you had to go stand in line to get your money out of a bank. They had bank holidays where the President Roosevelt basically declared a bank holiday and said, oh, listen, we're going to have a week. We're going to have a week where the banks are closed so that people couldn't withdraw their money from the banks. Now you're in a situation where you can just, online go in there and move your money instantly out of your bank and into another bank.
Yeah, where are you going to move it to, though?
You're going to move it to JP Morgan. You're going to move it to Wells Fargo. You're going to move it to Bank of America. But again, there's 4,700 banks. Okay. We can name where all of us bank, we can name on two hands probably everybody in your audience where they bank. I mean, 90% of the people. Maybe some people have a regional bank account. Do you have a regional bank? Who do you have a bank account with?
I'm at Wells and Citi.
I'm at Wells Fargo. Okay. So my point is that they're moving the money into these big, and it's really, they didn't think about this when they came up with Dodd-Frank And the problem is because now you have a good house, you have Wells Fargo, your money's safe there. It's safe at Citibank. It's safe at Bank of America. It's safe at JP Morgan.
Or no.
Right. Yeah. But the point is that the banks have been stress tested. They're stress tested every year. They make sure there's enough money in them. So we could go into a situation where just about, where the government was a highly regulated banking industry with a few banks is where it's going to go by the end of the decade.
Yeah.
A lot of the banks will just disappear.
How are we going to get there, though?
What?
Now, how are we going to get there? It's not going to be pretty, is it?
No, it's not. It's going to be very difficult and very volatile, extremely volatile. Yeah.
So do we eventually get deflation here? I mean, what we're seeing is M2 eroding, right?
Yeah.
New deposits going down. That's the measure of the money in circulation in banks and all that.
Well, I definitely think we're going to see deflation. I did, to come up with my projections, my 38% decline for the S&P 500 is based upon the S&P 500's, my research of it dating back to 1871, and its dividend yields during inflationary periods. And in that whole research I did, I also found all the periods where there was deflation for an extended number of years. So yeah, I believe that the Fed has lost control, and because of the mistakes they've made in 2021 and 2022, which are on my website. Okay, there's an article about that. Fed's mistakes they've made two policy errors. They're not. They've made the mistakes, and they've lost control, and everybody's going to lose faith in them. Okay, so when this thing goes into a depression, that wasn't supposed to happen. I don't know what's going to happen to the Fed, because they were supposed to be the stopgap, and they made two serious mistakes. And so we go back to a highly volatile period of rising prices followed by declining prices. They're back in the late 1800s, early 1900s. You'd have 5 years of deflating prices followed by 5 years of inflating prices. It was very difficult to do business, very difficult back then, and will become very difficult in the future.
All right. So what, as an individual investor, what are you supposed to do in the face of what we're up against here, besides moving your money to Wells Fargo or JP Morgan Chase?
Well, investors really need to, and this is a big problem, investors need to change their mindset to, first of all, buy and hold, forget about it. Okay? Buy and hold works during secular bull markets, which it ended in January of 2022. It started in 2009. And in the secular bull starts at the bottom of a secular bear. You just buy and hold, and it's like autopilot, like we were talking about the Tesla. Okay. So what happens, you have to switch gears, and you have to get out of the buy and hold mentality. You have to look for return of capital, not return on capital, because prices are going to go down. 38% is what I'm looking for, a decline for the S&P 500. So you're going to be able to buy 38% lower. Okay, so you want to be in cash when this thing hits bottom. And when it hits bottom, I'll be on your show and I'll ring the bell. Okay, but the point is, you want to be in cash, and you absolutely want your money in long, short hedge funds. Okay, because if you put your money in a long, short hedge fund, and from 1929 to 1932, that basically bought the dips and sold the peaks short. Okay, from 1929 to 1932, you made over 600% on your money. But if you bought and held, you lost 85%. Okay, same thing happened with the NASDAQ in 2000 to 2003. Okay, if you had traded the market short, the NASDAQ went down 78% during that time period, 2000 2002, and then during that time period, you made over 500% by buying the dips and selling the peaks. So you want to have money in a hedge fund, okay, that goes long and short the market. And if you're missing out if you don't have your money in that, and that's what we do at AlphaTac. We have algorithms, the same algorithms that I use to predict the peaks. I mean, the peaks and the troughs for the market can be used to trade the market. So they have a dual purpose.
All right. So that's one thing you could do. You stay cash heavy.
Well, you put, especially older people over 50, 55 years old, they should absolutely put a significant portion of their portfolios into, government bonds, 2-year government bonds, and of a government that has a AA plus or better credit rating, which would include the U.S., Switzerland, Finland, Sweden, those kind of countries, because you want to have your money in something at a government bond in which the government has the ability to levy a tax against its citizens to pay off its debts. Like back in 1929, after the 29-32 debacle, the tax rates in the U.S. earned income tax rates went to as high as 70 some odd percent and stayed there for years. So that enabled the U.S. to always pay. So if you're in an Eastern Bloc country or a South American country that can't collect their taxes and you've got the bonds, you're in trouble. If you don't have taxpayers who are willing to accept the higher taxes and pay them. So that's why you want only those countries that have AA plus bond ratings. And you want 2-year bonds because you don't have interest rate risk. So if interest rates skyrocket in a 2-year bond, you'll be okay.
Right. So 2-year bonds. All right. Makes sense. So now I see some banks are paying 4.5% interest. Do you take it?
I'd rather again, because of the banks, you understand the banks are all trying to get more deposit money. So, the regional banks will give you a higher deposit rate, but I think you're getting their rates are comparable to what the 2-year treasury bills. So I think you either buy your treasuries from the bank or you buy it from your brokerage firm, your online broker. I think you're much smarter to be in treasuries than banks, than bank deposits.
So what about money market funds that invest in treasuries?
Money markets are okay as long as they're invested in treasuries, but you're not going to get the higher yield on those generally.
Right. Gotcha. Yeah. So better off going direct to the treasury yourself, huh?
I mean, I think it's important, because of the volatility of the markets, if someone puts their money in a money market fund, there's that tendency to jump in when the market sells off big, okay, and put your money back in, and then you get killed, okay, because it's going to continue to ratchet down. So if you're disciplined, you say, you know what, the next 2 years could be tough, could be rough. Let me be defensive, put a good percentage of my money in a 2-year government and note. It's a decision you're making, that's more defensive, okay. You're not gonna have a tendency to turn around and sell that note 3 months later. You need to be conscientious. That's what investors have to be. They have to be conscientious and disciplined.
Disciplined, conscientious, and cautious.
Right. If you look, these hedge funds, we're looking at big returns. We're looking at 300, 400, 500% returns over the next couple of years. If you're a long short hedge fund, that's what kind of returns you're looking for. So if you put 20% of your money into that, 30% of your money in that, 70% of that, 70% of your money into notes, and I also recommend venture capital deals, but we can get into that in a minute. But I'm saying the hedge fund should enable you to generate a higher return in these volatile markets than you would have if you were fully invested, 100% fully invested in the stock market.
All right. So
you have to embrace the volatility, Kerry. Everybody has to say, hey, I've never done this before, but I need to embrace the volatility. I need to put a portion of my assets in a long short hedge fund. Okay, because those who do are going to, it's shown over time, you make a hell of a lot of money.
Right. Okay. Well, interesting. So hey, what can people get when they go to your site, alphatac.com, Michael?
Well, they can sign up for our, you can get access to hedge funds, investment advisors that have access to these hedge funds. And I have a weekly session every Saturday morning that I have that for my, that's free. So we go over these things every week on a Saturday morning at 11 a.m. You can sign up for that. You can sign up for our Alpha TAC Intel alerts. Another thing you can sign up for. So there's plenty of things to sign up for on the site. And there's also educational information. We have information about all the, secular bear markets, which I highly recommend every investor view the videos about secular bear markets, because the market is secular. We could have a whole show next time just on secular and explaining that. I could a whole interview on that.
Yeah, something that many of you out there weren't even alive for the last real secular bear market. Really in the 70s when the Nifty 50 crashed and burned, right?
Right.
You had those one decision stocks, they called them. You bought Kodak, you bought IBM, and you held them for life, and you could retire wealthy, right?
That's right.
I see how that worked out, huh?
Yeah.
All right. Well, interesting times ahead. Hey, we'll have a link to Michael's site on financialsurvivalnetwork.com in the show notes of this interview. While you're there, make sure you sign up for your free newsletter. Really appreciate you coming on, Michael. If you have a question for Michael, myself, shoot me an email, kl@kerrylutz.com. Write your comments on the YouTube channel below, and we will address some of them. Michael, thanks for stopping by. We'll talk to you soon.
Okay, thanks, Kerry.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.